So good morning. It is October the 16th. We're halfway through the month already, and we're a little over 2.5 weeks to the election. There's a lot to talk about, a lot's going on. I want to talk today a little bit about gross domestic product. I want to talk about the Dow Jones as we do every week and what's going on. We've had 3 down days in the market, but since last Friday, we're actually only down about 92 points. It's not as bad as you would hear on the media. So it's not that big of a deal, and we'll look at that chart in a second. The town halls were last night. It looks like we have one more debate coming up next week, and then 2 weeks from Tuesday, we start the election. The thing to remember as we go through this is there is some volatility. We've talked about that. There's some things to be prepared for. We've talked about that a little bit, and we've talked a little bit about the possibility of having a second dip, and I've said all along, October, November, I expected somewhat of a decline. But the thing to remember is that historically, regardless of who is elected, once the presidential election is finished, from that day to the end of the year, 76% of the time over the last 100 years, the market goes up. So it isn't the fact that one party or another, and I've had this question a lot, does it matter who wins? To a great extent, it doesn't. What matters is that the answer is given, and the market knows what's going to happen. We have a saying that the market essentially doesn't like what it doesn't know. So historically, once the election's over, once the winner's announced, the possibility of the market going up is pretty high. It's very favorable. So we have a lot of confidence in that. Then our only issue becomes, from the election, how long is it going to take us to figure this out? We've got record numbers in advanced voting right now. We apparently have record numbers doing mail-in voting. So in every state apparently has different rules on when we count the vote, when it has to be postmarked, and that can be an issue. So the positive feeling for us is that once it's all settled, then the market generally will probably go up. I looked at the notes for the FOMC that they did their September meeting, and all they really did for me was confirm what we'd already talked about. They're looking at a very flat economy. They're looking at 0 rates, or where they are now, into 2022. Right now, they've got the growth for next year set at about 4.5% to 5%, which is at best that's mediocre growth. 3.5% to me, in my mind, from an economic point of view, 3.5% is probably closer to 0. So we'll talk about that in a second. So Mallory's behind the big blue curtain helping me out again today. She's awesome. And let's go to our first chart, Mallory, which is the Dow Jones return and where we are. And you're going to see here that we've had this little dip I talked about on the far right-hand side over here. And you can see that our daily movement dropped a little bit. And then you've got the 7-day moving average and the 14-day moving average. And they're kind of flattening out a little bit. But still, the good part is from the end of September, they're still up a little bit. And you can actually see that we are essentially where we started the year at. So it's nothing to panic about. We don't really see, I've talked about that second dip coming, but we don't really see that yet. We have this Nike swoosh recovery. You can see it looks like the Nike logo, and that's kind of staying consistent. And it's going to be interesting for me a couple of years from now, stepping back and seeing what this does to the long-term chart. But right now, it looks like we've recovered decent, and we talked last week about how some sectors are doing better than others. But what we're paying attention to now, obviously, is what's going to happen. Now, today, it looks like a quiet mixed market, and the next 2 weeks are going to be interesting. But we're holding pretty well here. So let's go to the next one, Mallory. And this was the part of the week that was a little bit of a disappointment. We had in mind a number that we were expecting for unemployment filings, and it was, I'm going to use the number significantly because it wasn't a huge number, but it was big enough that we were all pretty surprised by it. So it's causing that blue line's the weekly filings, and then the orange line is the moving average. So you can see that it was coming down a little bit, and you're going to see that orange line kind of creep up some. And I'd commented earlier that the first part of October, I thought we would see no change at all. And I think that there was a general consensus among most economists, because we were going to see, obviously, the airlines were going to lose some employees, but we're going to start seeing some hirings in big box stores, distributions and things like that, get ready for the holidays. And those didn't really offset. So we saw this hit, and that's why that number is that blue line is kind of peaking up a little bit. Unemployment's at 7.9. We're still looking at being down about 4.5, 5 or so next year. So that's still good news. And I've said, I think every week I've said, fighting with this big peak in March is kind of like getting an F in a couple of years worth of all A's in college. And that F really hurts you a lot longer than you think. So we're going to fight a little bit to get that line down. And this week's number, it was disappointing. The adjustment for last week, I think we've talked again previously, they issue a number and then a week later they adjust it, and then maybe 3 weeks later they adjust it again. So our adjustments for the last 3 weeks are bringing us up a little bit. Not great, a little disappointing, something to keep our eyes on for next Thursday morning when they give us the number and we see the report. And that's where we are now. So Mallory, the next one, there we go. Treasury yields. This is kind of a bright spot. That spread that started back here, and that's kind of March right there. That spread continues to widen. So we don't need it really far apart, but we need a good distance between the blue line, which is the 2-year yields, and the red line, which is the 10-year yields. We need clients to be rewarded for long-term investment. Now, right now, the 2-year yield is at 0.137, which is, I want to say it's woeful. It's just terrible. But the 10-year yield is at 0.7473, so 0.75% for the privilege of investing your money for 10 years. That's a long time and a very low return. Now, again, see how that blue line is kind of feeding on the bottom there. That's where the FOMC thinks that line's probably going to stay for about the next 12 to 18 months. So that's what we need to be prepared for. What we need to watch is that red line and see if that grows a little bit and starts increasing our return. That will give us an indication of market growth. That will give us an indication that we're seeing a stronger recovery. So that spread is kind of nice to see, and it's going to be nicer when that 10-year starts climbing a little bit more. It'll climb first, and then the blue line will follow it. So we'll be watching that real carefully. And Mallory, go to the next one, please. And I wanted to show a little bit and talk some about the gross domestic product. That's going to become an issue over the next 8 to 10 weeks, maybe 12 weeks. The United States has the largest gross domestic product. And so we're clear, gross domestic product is the total of goods and services, how much we sold, how much we charged for it. But basically, it's what people are making as far as cars, airplanes, charge for services, somebody charges to provide a product. So gross domestic product is the total of all goods and services. The United States is the world's largest GDP contributor. This number here is 2018. 2019 went up a little bit, and that wasn't included on my chart. It went up about $1.4 trillion. What's going to happen is 2020, right now, we're forecasting that blue line with that big blue dot on it right there that Mallory's pointing to. That number is going to drop. I don't think it's a question, but it is going to drop. And it's probably going to drop to about, my guess is 19.7, 19.6, somewhere in there. So you will see a decline, all related to COVID, all related to economic shutdown. But it's still important to note that the second number is China is still at only 13.6. And we're going to go to the next chart, and that shows this is the global economy. So as far as GDP, the United States is 23.6% of the world GDP. And then you have the big five. You got the United States, China, Japan, Germany, and India. Those totaled are 52.7% of world gross domestic product. So these 5 countries are 52.7% of the gross domestic product. Now, something that I always do, and something that we in general do, is we rarely look at one number. If we see a stock that's got performance, we look deeper into it. Why? If we see a mutual fund where we got a rating at Morningstar, we look deeper into why it's got that. In this case, on GDP, one of the things I look at is the percentage over on the right-hand side in light blue. That's the population. So the interesting part about this is this 52.7% of the GDP produced by the big five, is only 42.4% of the population. And then you look down the side and see where that population is made up, and you look at it, and it's pretty interesting. So the United States is 23.6 of world GDP, but our percentage of the population isn't very big. And the interesting part about that is if you look at China and India, the second and the fifth of these big five, and they basically have a population, each of them 5 times the United States. It's a pretty impressive number. So if you ask someone what's the population of China, they're going to say, a billion people. It's actually 1.3 billion. So they're lopping off the entire population of the United States, which is 323 million or so. So China and India are about 5 times the size of population, but we still are the leader in GDP. The point for this is that when we're talking about economic recovery, when we're talking about world economics, the GDP for the United States is still the leader in the world, and we've still got even the second person has a long way to go to catch up with us. And we can talk about debt, and we will talk about debt later. The next 5 countries are the United Kingdom, France, Italy, Brazil, and Canada. They make up only 12.8% of the GDP. And then you've got the next group, which are countries you obviously recognize: Russia, South Korea, Mexico, Turkey, Saudi Arabia. And you have that oil in there, which is interesting. That's 13.3%, those combined. The remaining 173 countries make up a little over 20% of the world GDP. So you've got the top 5 and the bottom 173 contributing about equal amounts to world GDP. So we are still and remain to be the leader. The big 5, we're doing more than half of the GDP in world economics. So as our country grows and as we recover, we're going to lead the world. We're going to be the stronger. And you recall, it's not a chart I have this week, but the chart I've always shown. How are we recovering? And the United States is always leading the way. So we continue to do that. And again, I don't have that chart, but NASDAQ is leading the way. NASDAQ right now is up to 11,713. Now, the comment I will make about the Dow is that we're at 28,494 as of last night. I think there's a very good chance that we'll see 30,000 by the end of the year. That's actually a number that you're not seeing a lot of. The other one that is the S&P 500, which is closed last night at 3483. There's a really solid chance that that'll be 4,000 by New Year's Eve. So those are 2 observations right now. The insight that we're giving where we think we are. We kind of have our seatbelts on for the next 2 weeks. See how the election goes. And again, just for comfort, the point is not who gets elected, it's the fact that we get it over with and the market then knows what direction we're going to take. Will it change what we do here? Maybe a little bit. We might change some things. We know that what we've always said is the things that always will be a need is financial services, energy, and healthcare will always be a need. It's a matter of adjusting those percentages and allocation when we look at, do we buy more energy? Do we buy more oil? When is the right time? You can't time the market, but we know that right now you're not going to see a big increase in oil prices for a bit. So we don't want to start putting money into something we think is going to flounder. Will the presidency change what we do? A little bit, but not significantly. It'll change some of our percentages, but you're still talking about 100% of investments spread out over 11 sectors, and it's just not going to be that terrible. So that's where we are. We've got 2 weeks left before the election. Everybody make time to vote. We will be back here 1 week from today, and we're going to start having a guest from time to time. And our next guest is going to be sometime in November, where we'll bring in a fixed income expert who's agreed to sit and visit with us. And that's going to be a great conversation because right now fixed income is, it's pretty tough to find good, solid fixed income. So we're bringing in a fixed income expert to visit with us for a few minutes one Friday in November, and we'll let you know how that goes. Thanks for joining us. We really appreciate your time. I see some names I see repeatedly on here, and it's nice to see you every week. And then we see from time to time new people join us, and that's great to see too. Invite your friends and family, and thanks so much for joining us. Have a great weekend and have a great week. Thanks.